Welcome to this video on stocks. In this video, you will learn: what is the stock of a company? Why do investors buy stocks? Types of stocks. And the risks associated with owning stocks. Let's start by understanding what the stock of a company is. Stocks are a fundamental investing vehicle in the financial markets. They are also known as shares or equities. Usually, companies issue stocks to raise funds, to operate and expand their businesses. Investors or stockholders buy the stock of a company. It gives them a share of ownership in the issuing company. The level of ownership of a stockholder is determined by the number of shares a person owns relative to the number of outstanding shares. Stocks are bought and sold predominantly on stock exchanges. Now that you know what a stock is, let's learn the benefits of owning a stock. Apart from getting part ownership in the issuing company, investors see other benefits as well, such as capital appreciation, which happens when the price of the stock increases; dividend payments, which come when the company distributes some of its profit to stockholders; and an ability to vote in the company shareholder meetings. Two main kinds of stocks are common stocks and preferred stocks. The stocks that retail investors buy on stock exchanges are common stocks. It entitles them to vote at shareholder meetings and receive dividends. The preferred stocks do not have voting rights. However, they receive dividend payments before common shareholders. Another way to categorize stocks is by market capitalization. Companies are usually categorized as large cap, mid cap, small cap. Additionally, very small priced stocks are known as penny stocks. The criteria for this categorization changes from market to market. Though stock prices usually rise over the long term, they swing up or down quite a bit. Some investors find such fluctuations to be disconcerting. Also, if a company goes bankrupt, common stockholders would be the last to receive any return on their investments. And don't forget, prices would have already started falling steeply. Even when companies aren't in danger of failing, stock prices are by nature non-constant.